Succeeding in the APPSC Group 1 and 2 exams requires moving beyond the rote memorization of banking definitions. The current testing standard requires a first principles understanding of how money moves and multiplies across the economy. This movement occurs between three specific nodes: the public, commercial banks, and the Reserve Bank of India. Money is a dynamic flow. It cycles between these three actors at high velocity to sustain economic activity. Mastering the relationship between these nodes is the requirement for solving the multi-layered assertion-reason questions found in the latest exams. Money circulation is the velocity of transactions, the speed at which currency moves through the hands of the public. The Indian informal sector, particularly agricultural labor, depends on this physical circulation as a primary operational input. When an unexpected event like demonetization causes physical currency to abruptly vanish, the entire economy faces an aggregate supply shock. Without the required cash input, transactions face immediate friction and normal economic output ceases. This demonstrates why reducing physical cash circulation chokes informal output directly, even if bank digital reserves remain stable. We often view the central bank as the primary architect of the money supply. In practice, commercial banks manufacture the vast majority of the liquid capital circulating in the modern economy. Every rupee deposited by the public serves as raw material for further monetary production. Through fractional reserve lending, banks retain only a small portion of deposits and lend the rest, effectively creating new digital money. This turns every commercial bank into an engine of exponential monetary expansion, a fact that dictates the outcome of most monetary policy scenarios. The mathematical governance of this expansion is captured by the currency deposit ratio, or CDR. Under a baseline CDR of 1, the public holds 50% of their wealth as cash and deposits the other 50% into the banking system. If 100 rupees enters this system, 50 stays in a pocket, while 50 enters a bank vault. The bank lends a portion. When it reaches the next person, the ratio applies again, looping money back into the system, multiplying its value. Consider a scenario where public anxiety leads to cash hoarding, driving the CDR upward. As the ratio shifts toward cash, the stream of new deposits dries up, which instantly chokes the bank's ability to issue new loans. A higher public preference for cash directly shrinks the money multiplier, creating the specific downward pressure on money supply that often appears in analytical exam questions. Exam questions frequently mention a change in interest rate, without specifying if it refers to deposits or lending. From macroeconomic policy questions, you can assume the effect is consistent. Whether deposit or lending rates shift, the tightening or loosening of liquidity follows the same path. In the context of a descriptive mains answer, however, you must be specific about how banks price their credit. This pricing is governed by the marginal cost of funds-based lending rate, or MCLR. This external benchmark acts as a rigid floor for all lending rates. This benchmark floor limits how cheaply a bank can lend, effectively placing a cap on the velocity of the money multiplier. This multiplier engine carries significant systemic risk. Every loan issue to expand the money supply creates a liability on the bank's balance sheet. These loops expose the bank to credit risk and market volatility. When loans fail to generate returns, they must be reclassified according to this flowchart, moving from standard into non-performing status. As assets deteriorate through the substandard and doubt categories into loss, they begin to outweigh the bank's underlying capital. This leads to insolvency, the point where the bank's debt obligations to its depositors exceed the value of the performing assets. The mathematical mechanism that provides liquidity also threatens to collapse the entire financial system if it is not heavily regulated. The international response to this risk is the Basel norms, a set of regulatory guardrails designed to prevent banking collapse. Basel forces banks to hold capital in reserve against risk-weighted assets, stored in Tier 1 and Tier 2 pillars. These pillars serve as shock absorbers. When a loan enters a non-performing category, the capital buffers take the hit, protecting the bank's core stability. This creates a permanent tension. Commercial banks strive to maximize the money multiplier, while the RBI enforces Basel limits to mitigate risk. Every regulatory move balances the expansion of money against the strict necessity of risk mitigation. Understanding this tension helps you solve the most complex banking scenarios in the APPSC curriculum.